lot of people. So, so basically, you'll be able to send this, and hopefully you'll even get more exposure as.
Yeah.
So.
That sounds great. Now I'm excited, Andrew. This is, I've been looking forward to the opportunity.
Absolutely. So you started another fund prior to this, and is it fully invested, or is this the first fund that was started?
So the accelerator had a modest debt fund some years back that's fully deployed. There's only $2 million that was invested in, smaller. There was a debt fund as well, not an equity fund, to provide, working capital for small minority companies.
Okay, but so it shows a pattern and consistency. You tried it as a debt fund, which works for some groups. And did you offer competitive or lower rates possibly, or?
Basically the purpose of that fund, our rates were competitive, but the idea was, for folks that could not qualify for traditional financing because they perhaps didn't have enough collateral or their guarantor wasn't strong enough, the fund would provide for those unable.
What type of provisions do you put in place or risk parameters as if they had, let's say, bad credit or something? It's
like I said, it was more about lack of collateral and things of that nature. We were prudent. This wasn't we were following in many cases the traditional underwriting guidelines, but the lack of collateral should not be the reason someone doesn't get a loan.
Oh, no, agreed. Absolutely agreed.
Yeah.
Were your rates lower than or competitive?
The rates were competitive, but actually in many cases a tad higher because we were taking on a risk that banks weren't. So it was priced accordingly. So it was a little bit more expensive than a traditional bank, but we were taking a risk that banks wouldn't take.
Yes. Are we talking, how long ago was this?
I'm sorry?
How long ago was this?
So that fund basically formally kicked off in 2014. The dollars were kind of fully deployed in 2018. We've got some terrific success stories that have come out of that. Again, in fact, we have several of those companies that are now of a size and scale that they're now positioned for.
Maybe that's not a bad idea, is to talk about one of the companies from the debt fund that had a positive impact from the loan that they would not have been able to get
Correct.
to what they turned it into. I think that would be a good.
It's one of our, when I mentioned we have live deal flow, one of our deals for the new fund is a direct result of the prior fund.
Yeah,
meaning
so
that
it's just trying to make I'm not sure. We typically start like 3 minutes after 1 o'clock. Just give people time to come on.
Sure, absolutely.
So, have you done a lot of public speaking with these?
Yeah, I'm old, Andrew. I've been at this in 33 years in some way or another. I was a banker for a long time in Cleveland, 16 years as a lender. I ran business banking for a couple of banks covering 3 states.
Which ones?
Before I got
what type of banks?
My career started at National City Bank before PNC acquired them years ago. And then, so most of my career was at Nat City. And then I spent a little bit of time at Key Bank, running business banking for them for Ohio, Michigan, and Indiana before I got into venture and private equity and economic development. So, so I've been at this personally and professionally for a long time.
That's
I'm sorry?
I said it's a great pedigree. That's it lends the years of experience from banking and PEVC to recognize opportunities, and you know, that's pretty important.
Yeah, and there's a little piece of that I'll share in my opening comments. But I mean, honestly, Andrew, early 90s, I was one of two African American bankers that had lending authority back in those days, which meant I could sign for loans personally. So that word got around town. If you need a loan, go see Darren, right? And so I got to know the minority businesses up close and personal. And so I've been a walking study of minority business as long as I can remember, right? And so took years and years of that and now parlayed it into the work that I'm doing today.
Wow, that's right. Hold on one second. Hold on. Is this
However you do what you
okay? I'm just making sure we have everything on our end covered here.
Okay.
Just 2-3 minutes and we'll start. Okay, just
Will I see the registrants pop up on the screen or no?
I don't know.
Okay.
I don't. It's a good question. We see it on our end. I don't.
Yeah, because right now I just see, of course, you and I.
Yeah, no. So we have a live chat where people chat, and we see all the attendees, and so I guess that's on our end.
Okay. No worries.
All right. So just just about a minute, and I'll be right back.
No worries.
Oh, sorry about that. Darren, I wanted to introduce you to Family Office Networks, and good afternoon, everyone. This is Andrew Schneider, and I'd like to welcome Darren Readiness from the Minority Business Accelerator. It's a non-for-profit and a for-profit fund that is a very clever and I think the most efficient and effective way I've seen or heard how a non-for-profit and a for-profit can help a charity and a philanthropy get the best results. And Darren's pedigree goes back over 30 years, from banking to lending in the, we'll say, Cincinnati and greater Ohio area. And with this being said, I'd like to introduce Darren and let Darren please take it from here.
Awesome. Thank you, Andrew. And good afternoon, everyone. I am just delighted to be here. And I guess depending on time zones, it may not be afternoon, but afternoon where I am. So again, thrilled to be here. As Andrew mentioned, my name is Darren Readiness. I serve as the Chief Executive Officer of the Minority Business Accelerator, which is an effort that is now in its 18th year, housed in the Cincinnati, USA Regional Chamber. And we have some pretty exciting things underway that I think you'll find very interesting, especially in lieu of all that is taking place in the nation today. And so before I kind of dig into the presentation, however, I wanted to just spend just a couple of quick minutes on just who I am and my background, just for context and just perspective. And so, as Andrew mentioned, I've had the good fortune of being at this work now for the better part of 33 years, beginning late 80s as a banker in Cleveland at National City Bank at the time. And so I spent about 15 years at Nat City, kind of rising up through in their ranks and ultimately running business banking, and then ultimately spent a little time at Key running their business banking for Ohio, Michigan, and Indiana. And unbeknownst to me, quite frankly, at the time, sadly, if I go back to the early 90s, I was one of two African American bankers in the city at the time that actually had lending authority back in the days when they were actually giving individuals personal authority. And the fact that I had that just drew a lot of attention. That word, if you will, got around town. If you need a loan, go see Darren. And so for better or for worse, I got to know the minority entrepreneurs in the market up close and personal. And early on, it was an opportunity for me to understand where entrepreneurs are and the gap that I needed to close to get them ready for the bank's credit committee. And so just 16 years of ripping companies apart and putting them back together, regardless of industry, stage, size, from startups to companies that are multinational. And so I was able to kind of parlay 16 years of that, and then started my own firm back in the early 2000s as an outsourced kind of chief financial officer. Took a couple of my banker friends with me, doing the things for small businesses that we saw they had a difficult time doing when I was on the banking side of the fence. And then kind of condensing a long story, ultimately got into economic development. Cleveland happened to have one of the country's first tech accelerators. So I was able to lead that organization's diversity and inclusion efforts for about 7.5 years. Ultimately left to start another company, which they became my first client. And so I have been advising communities, organizations, entrepreneurs, et cetera, on growing larger scale minority firms for quite some time. What led me to Cincinnati real quickly is that, which I've been here now, will be 6 years in January. I wanted to try to find a model, something that was already working fairly well that I could ultimately take to the proverbial next level and have it then inform this work across the country. And I am thrilled to say that we are certainly at that place today. Cincinnati, over the past several years, has been recognized as a national best practice for the work that I'm about to share with you. And even just this past Thursday, the federal government, through the Economic Development Administration, awarded us with a very significant grant to continue our efforts. And so lots of history, lots of momentum, lots of track record in this space. But in sort of kicking off the presentation, the primary opportunity that I'd like to kind of dig into is the fact that despite being over 30% of the population and growing, nationally, less than 1% of equity capital is invested in African American and Hispanic-owned businesses. Now, there's an entire presentation, an entire webinar series in terms of explaining why these disparities exist. But suffice it to say that there's years and years and years of economic disparities, lack of access to capital, and then most of your historical access to capital efforts, be it by the federal government and others, have always been about debt. And so the equity capital piece, which is by design, trying to invest in high potential businesses, has really just not found its way to African American and Hispanic firms. So again, 1% of equity capital is invested in those populations, which represents just an enormous growth opportunity. Before I dig into that further, I want to spend a little bit of time talking about our work and our mission here at the Minority Business Accelerator. And then later I'll talk about this new fund that we're in the process of standing up. But the mission of the Minority Business Accelerator, as you'll see here, is to accelerate the development of sizable, keyword sizable, minority-owned businesses and strengthen and expand the minority entrepreneurial community through access to capital and other resources. A little bit of history here. So as I mentioned, we're in our 18th year now. And importantly, this work was founded in 2003 after the civil unrest or the infamous Cincinnati riots back in 2001. And so the community responded in a big way to try to address economic disparities. And that time, this work was specifically targeted to the African American population to address economic challenges, but try to have a particular emphasis on providing resources to diverse firms to prepare them for our large corporate supply chains. We're blessed to have some great organizations here in the Cincinnati region. It was not by accident that this work was housed in the Cincinnati Chamber. So then and now, this work has been focused on creating the kinds of businesses that can do business with our Procter & Gamble and Kroger and Fifth Third and many other organizations here in town. The work began with 20 companies at that time with average revenues of about 6.7 million. To date, we're bumping up on 70 companies that have been through our process with the average revenues being about 30 million. The fund that I'll get into momentarily is sort of the next logical step of our work. We have been, if you will, a fundless fund for 18 years. We have been identifying and sourcing and preparing companies for capital, but we would always introduce them to resources. We've never had, in a big way, our own capital fund with which to write our own check. And so our fund that I'll talk about momentarily is the logical evolution of 18 years of this work. At its core, our accelerator model, so the work that's now been going on for 18 years, it is fairly straightforward in that, think of us as a boutique consulting group, where on one hand, we work with minority firms that we call portfolio companies, and on the other hand, we work with our corporate partners that we refer to as goal setters, meaning that they're setting goals to do more business with women and minority-owned firms. Back on the left side of the screen, in terms of the kind of work that we do for these portfolio companies, looks in many ways no different than a typical consultant, if you will, may dig into. However, the level of depth and intensity and focus, et cetera, around our SWOT analysis, capital readiness, all the things that we know a business needs to grow and scale. And then on the right side of that equation, really working with our corporate partners, helping them truly understand the business case for this work, helping them diversify their supply chain, which creates more competitiveness within the supply chain overall, is really at the core of our work. We have a very bold goal. Within the top of this house here, where you see vision and bold goal, we have a goal here to grow the spending with our minority firms by $1 billion and create an incremental 3,500 jobs in the next 4 years here. Importantly, both of these numbers, this $1 billion and this 3,500, represent where we are today. So this, in effect, is doubling what we've done and doing it in a relatively short period of time. So how do we intend to get to this $1 billion of growth? And it's through these 4 key pillars of work that I've got illustrated here, fundamentally in the spirit of what we call grow, build, attract, and create. So the grow pillar fundamentally just means let's grow our current companies of size to their next level. So this is really the historical work of the accelerator simply continuing on. So if they're at 10 million today, how do we grow them from 10 to 20? If they're at 50, how do we grow them from 50 to 100? And importantly, unlike today's accelerators, we don't graduate our firms because there's always another level. So importantly, entrepreneurs that have been working with us, many from day one, we still work with to this day, but we're not the typical accelerator that has a cohort, sends them through some training and then graduates them. Every year it's a re-up for the next level of growth. So the build pipeline is really building a pipeline of emerging minority firms. We say emerging, meaning companies under $1 million in revenue, which is typically our floor to get into our group. But this build pillar identifies companies under $1 million that we believe have high growth potential. And we do that through a collaboration of organizations in town referred to as the Cincinnati Minority Business Collaborative. In that build pillar, we're trying to identify 50 high potential minority firms over the next several years, or 10 a year, or 50 in a five-year time frame. Our attract pillar quickly is just attracting larger scale minority firms to our region in gaps of where we don't have them. And then finally, the create pillar, which is likely getting the most attention, is creating minority-owned firms through the acquisition or purchase of mainstream or non-minority businesses, if you will, with no succession plan, no kids in the company interested in taking it over. How can we arm and prepare credible minority entrepreneurs to acquire existing companies as opposed to always having to grow them organically from the ground up? And depending on which report that one may read, there are literally trillions of dollars in play across the country today of just the baby boom generation, business owners that they're beginning to age out. There is no formal succession plan. Kids don't want to run the manufacturing plant, if you will. And so what a phenomenal opportunity to, again, create minority firms through acquisition of mainstream firms, which also just creates a great exit opportunity for the seller. Moving into the fund, so that backdrop was just really a little bit of context because there's a lot of history that's now leading to the launch of our fund. And so as mentioned here in the text box, we're creating a fund that's providing equity and flexible debt financing, so equity-like financing, for high potential entrepreneurs of color to support targeted acquisitions, as I mentioned, traditional growth equity, and early stage follow-on investment. I'll talk more about those three targets in a moment. From an investment target perspective, there's again three fundamental areas. First piece, as I mentioned, mainstream companies that lack a succession plan that we then pair with a credible minority entrepreneur to create minority firms through acquisition. Importantly, our banking partners, of which I'll talk more about momentarily, that are the early investors in our fund, really see this as an enormous opportunity. Our banking partners are the same partners that their clientele are the small to mid-cap companies that they acknowledge do not have succession plans. And so that particular piece is just significant from an investment strategy standpoint. So again, acquiring existing companies without succession plan to create minority-owned firms. The second piece is really investing in traditional growth equity, an existing minority firm already of some size and scale, but it now requires a capital infusion to get to its next level. Perhaps it's trying to launch a new product line, or it's trying to pivot to a related industry, or build out its management team, or invest in a robust technology platform, but something that requires some cash today to get to their upside potential. And then the final focus area of our fund is more on the early stage and technology side, but importantly, not startups. In this particular bucket, what we're looking at is existing minority firms that have already been seeded. They've gotten some angel investment, perhaps some early stage capital. They've gotten some customer traction, but now it's time for that traditional follow-on sort of Series A investment round, which is a difficult and daunting task for any entrepreneur, but disproportionately entrepreneurs of color are not landing money with the VCs, often, per my earlier comment, about less than 1% of equity capital finding its way to African American and Hispanic entrepreneurs. And there's lots of reasons that I won't spend a ton of time on, but suffice it to say that at that stage, perhaps that business was deemed not enough of a disruptor. Perhaps it wasn't deemed to be the next billion-dollar company, but perhaps it could be a legitimate and meaningful $50 to $100 million company, which is still a great investment opportunity. And so there's so much opportunity in that particular bucket as well. All three of these obviously focused on growth and scale, but acquisitions of mainstream companies, supporting existing minority firms of size, and investing in early stage tech companies that require follow-on capital is the primary focus of our fund. The fund itself, from a target standpoint, geographically, we're going to be investing in typically your small to mid-cap companies, but typically about $1 million or so in earnings before interest and taxes and depreciation. These are companies typically anywhere from a few million to $50 million or so in revenue. Our work is purposefully geographically focused in the Cincinnati MSA. However, the fund will invest 25% of its capital more broadly. And importantly, since the fund is also being set up in what's called a CDFI, or a community development financial institution, our bank investors will, one, get the Community Reinvestment Act credit for investing in our fund, but also more importantly, because of that designation, which also is a community impact play, a non-minority firm, if you will, that may be located in a low to moderate income census tract would still qualify for investment for our fund. So there is a broad swath of deal flow opportunities for our investment profile. In terms of just a quick high-level view of our portfolio, sort of mixing construction, at the top right-hand corner, I mentioned that about 50% of our 50% of the capital will be going into acquisitions, 35% traditional growth equity, and about 15% in earlier stage companies. I won't read everything here. The fund boundaries, as I mentioned, about 75% in the Cincinnati MSA, 25% more broadly. This is kind of a visual picture of what I was articulating. And in terms of our return profile, basically on our multiple of invested capital, 1.5 to 2x return on capital, generally 10 to 12 on the IRR, and looking at an investment period of about 5 to 7 years. This is our investment team, which I'm super excited about. I'm blessed to be the fund manager for the fund, but as you see, we have really the creme de la creme of investment professionals in the Cincinnati market and beyond. I won't kind of read all the profiles here, but an extremely experienced and diverse investment team that will certainly just provide phenomenal insight, perspective, experience, et cetera, to our investment decisions. I will call out one just for the sake of an additional unique spin. Carmen Ortiz McGee, the fourth person kind of listed there, serves as the executive vice president of an organization called the National Association of Investment Companies, or the NAIC. And for those that may not be familiar with the NAIC, it represents over 100 now of private equity, venture, hedge, various equity capital funds led by people of color. And so as basically a trade association, Carmen's experience, network, relationships are second to none in this space. And so we are thrilled to have her on our investment committee, as we are with our other members as well. In terms of governance, as I mentioned, we are intentionally housed within the Cincinnati Regional Chamber. And so the fund itself will be ultimately owned by the chamber. The chamber will own a management company. That management company serves as a GP in the fund. Some of the legalities there, but ultimately this kind of worked its way up through the Cincinnati Chamber. The accelerator itself has a phenomenal board of managers, representative of corporate CEOs, philanthropic leaders, et cetera, in our region and beyond. I mentioned our investment committee will also have a member advisor committee, basically our key investors in the fund that also have a voice and input into our strategy and execution as well. This is really just a quick example of a sample deal structure. And I bring this up because, as I mentioned, about 50% of our capital is going into acquisitions. And so being a longtime banker, I kind of can't get away from this stuff, but what you see here is a typical transaction. So what I listed here is really just a $5 million transaction, just as an example. And so typically a lot of these, let's say it's a manufacturing firm, it's selling for $5 million. The bank, will not, of course, finance 100% of any transaction in most cases. So let's say it's 60%. It's fairly common for the seller of a company to be willing to take back a note or some paper for about 10%. You've got this equity component from the entrepreneur. I have it 5%, and then the MBA fund coming in at $1.2 million. Importantly, our fund, fully funded at $100 million, can invest up to $10 million per transaction. This is just a basic example here. But what it also, I'm trying to illustrate here, is that if you take the MBA fund out of that equation, and then you're just looking at bank financing and seller financing, you have anywhere, from in this particular example, a 40% gap that typically that entrepreneur has to come up with on his or her own. And for a variety of reasons, a lot of folks are probably very familiar at this point with a lot of the disparities around wealth disparities, et cetera. And so often our buyers simply just don't have sufficient liquidity to close out a transaction. And so our fund is designed to provide that equity gap, to shore up that remaining capital stack, if you will, to enable these sorts of transactions to come to fruition. And it's this sort of activity that is really getting our banking partners excited. In fact, we had a recent presentation with one of our banking partners that teed up an opportunity for me, much like this, to speak to 45 of their lenders across their organizational footprint. So as I explained just now what we're trying to do and the unique opportunity that it creates for their seller, which I'll explain momentarily, immediately we got 3 referrals and are now in due diligence on looking at some acquisitions. And so, it's just a perfect opportunity to partner with the banks. So one final piece before I move into Q&A, I mentioned the unique opportunity for the seller. And this is really what's getting our banking partners excited. So without digging into this too deeply, given the events of the past 18 months, following the murder of George Floyd, Breonna Taylor, and others, and you began to see a response by many corporations looking to make big announcements about doing more business with women and minority firms, or particularly minority firms in this case. And so there's hundreds of millions of dollars being at least identified to try to do more business with minority firms. But this is what's not getting communicated. The reality is that given our work, we certainly know this up close and personal. Many of these same corporations making these big announcements are not articulating the fact that if you look at their supply chain, you simply will not, in many cases, identify minority firms of size and scale that have the wherewithal to be suppliers to big corporations. So what does that create? It creates gaps in the supply chain. We just don't see very many entrepreneurs of color. So where's the opportunity there? So let's say we're now armed with these gaps. And for the sake of example, I'll talk about the manufacturing gap. Manufacturing as a sector in and of itself, think about the heavy equipment, CNC machines, and just the heavy assets of manufacturing, overlaid against historical lack of access to capital for people of color. Of course, you're not going to see a lot of minority-owned manufacturing firms in today's landscape. But what a phenomenal opportunity, as the current owners of manufacturing firms don't have succession plans to actually sell to a credible minority buyer. So what does that do for the seller? So let's take an example of a $10 million manufacturing firm that's a mainstream company, and post-acquisition, it is now a minority-owned firm. We leverage this buying power and buying demand of all these corporations, and we grow that same $10 million company to 20, 30, 40, 50 million or better. Of course, there's no guarantees there, but the opportunity there is real. The seller of that company can ride that upside through an earnout, which is just kind of standard deal structuring vernacular, if you will. But that earnout in this particular example is unique to selling to a credible minority buyer. And that earnout is really getting our banking friends, our accounting friends, our lawyer friends really excited about, if nothing else, sharing this with their mainstream clients. If nothing else, we help bring more credible buyer to the table, but at best, we can also create a unique value proposition for their seller. So that is the gist of the opportunity as a whole. This kind of final piece just talks about a snapshot of the fund terms itself. So the Minority Business Accelerator Fund, a limited liability company, being set up as a CDFI, as I mentioned, which is a special designation out of the U.S. Treasury's office, which again will give our banking partners CRA credit. The Chamber Foundation ultimately serves as the fund manager. We're targeting 100 million, minimum 25, but we're already at that number and looking to have a first close of the fund at 50 coming up here in the fourth quarter. Our investment period will be about 5 years from the initial close. It's going to be a 10-year fund, standard management fee of 1.5%, carried interest, the return expectation, if you will, back to our investors. The minimum investment in the fund is $1 million, and then the reporting piece kind of as you see. And so I ran through that purposefully, fairly quickly, to enable us to sort of get into some Q&A, and happy to answer any and all questions, either about the accelerator itself or the new fund that we're in the process of establishing. So thank you so much, and just happy to dig in further.
Well, Darren, very, and thank you very much. I had a few quick questions myself in regards to the fund. Can you tell us who the auditor and the legal are?
So the auditing firm is BKD, which is the same group that we work with here at the Chamber, so BKD. And our law firm for the fund is Dinsmore and Scholl.
Excuse me. And the other question I had is the hurdle rate. Is this what we call a hard or soft hurdle rate? Meaning, after 8%, do you start charging the 20% on anything above 8%, or if you surpass 8%, do you charge the performance fee on everything?
So thank you for that question, Andrew. Really, so in this case, what we're referring to is for any returns of the fund, the first 8% of those returns go to our investors. And so it's just another way that we're trying to create some additional incentive and value for our limited partners. And then 20% going forward is what we will participate in. The 80%, of course, going to the limited partner investors. And so whatever the return is of the fund, the first 8% of that will go to our limited partner investors, and the balance shared 80-20.
Okay. I've got a family office from Northern California that wants to know when the fund is closing. I understand that when you and I spoke, there was some type of soft close you were doing by Thanksgiving. So I'll let you respond.
Yeah, thank you, Andrew. Yeah, so just full disclosure there. So we're targeting a $50 million first close. We're about halfway there with additional dollars presently in due diligence. So we're hopeful that we can have a first close of $50 million before the Thanksgiving holiday. So targeting November 15th, and then continue on fundraising, of course, into 2022 with a second, and if need be, a third close into the second and third quarter of 2022, but really trying to get this fund off the ground and launched here before the holiday season.
So basically, any investor really has October and part of November to make the investment.
You got it, absolutely. And it would be fantastic. I mean, the initial group of investors, just to be able to announce as part of our first close, and we've got several banks that are already committed, et cetera, but it will be just fantastic to also be able to include any of the family office network family as well. Would just be terrific.
That's great. I've got a question from a family office in New York City, and
Okay.
they would like to know the investments at 100 million. How many investments do you plan on making, or that you've identified as of now with what you currently have?
So once fully funded at the 100 million, the expectation is that we would make about 25 or so investments. And so we're anticipating, an average deal size anywhere from 3 to 5 million. However, fully funded, we can do 10 million for any one company. But the target that we're looking at is really on a per deal basis, between $3.5 to $5 million per company. We have a very robust pipeline. In fact, there's several companies that we are looking at literally as we speak, and that what we are anticipating is that when we have our first close coming up here in the fourth quarter, we will also be able to simultaneously announce our first one or two investments. And so, we're part of our deal flow strategy. One is to certainly leverage the 18 years of this work that the accelerator has been able to grow minority firms, leveraging our banking partners, our CPA firms, our lawyer partners. We are very fortunate, and I didn't get into a lot of this, but if I take one quick step back just for additional context, we find ourselves in the center of the national conversation on this space, which is attracting opportunities from all over the country. But I'll be more specific. If I go back to last summer, at the height of the national unrest that we were all experiencing in the country, many cities, as I mentioned earlier, wanted to think about how they respond. So in their quest to respond, they began to hunt for national models. And as that hunt intensified, Cincinnati kept bubbling up to the top of everyone's list. So here we found ourselves last summer already with the nationally recognized model, 18 years in, born out of our own civil unrest back in 2001. And then finally, which I have not mentioned, armed with a documented quote unquote playbook that the Kauffman Foundation funded on our behalf. And so it just so happened that our work with the Kauffman Foundation began about a year prior, but the playbook was actually completed last summer. So not only did we have our 18-year track record, et cetera, but a literal document from the Kauffman Foundation that we could share with other cities. And so what does all that mean? So we're able to leverage not only our work here in the region, but as I mentioned, the fund will invest 25% more broadly, and we have just extraordinary relationships with many cities and intermediaries and centers of influence, and we feel fantastic about our deal flow, especially in those three buckets that I mentioned: acquisitions, growth equity, and follow-on funding for emerging tech companies.
Darren, you and I spoke about you had a debt fund or a lending fund prior to this. Could you give us an example of one, maybe success story that you've had and why you set up the lending or debt fund to begin with?
So yeah, thank you, Andrew. So yeah, because of the work that we've been doing now for some time, back in 2014, we were asked by our philanthropic community to launch a small debt fund. It was a $2 million debt fund, unlike what we're talking about now, which is an equity capital fund. But at this time, this was a debt fund, really trying to provide, working capital as well as traditional, term loans, but for minority firms that for various reasons were unable to attract traditional bank financing. And so there was a particular company that we invested in at that time with a modest $50,000 loan that today has gone from really a couple $100,000 in revenue to over 4 million, and are now poised for equity capital in our proposed new fund. And what's amazing about the particular company is it really speaks to the pathway. And so I mentioned our 4 pillars of work and pipeline building, et cetera. So that's a live example of a company. They happen to be a technology-based firm in financial tech or fintech that is really poised to become, a significant player. Many of their clienteles are the large institutions, and so and there's several others, Andrew, that were very modest at that time, but have now gotten to a place where they're multi-million-dollar companies and positioned for even greater upside.
I mean, that's what an incredible kind of journey. As it went from lending to debt to now equity, and I think that's really a huge benefit for the underlying company and people that will be benefiting from this. I think we have just one more question.
Okay.
This has to do with the underlying fund in regards to the committed capital. How much or are there capital calls, and what type of provisions? If you could elaborate. This is a more specific question. I don't want to identify the individual's name, but if you could just expand on that a little bit.
So in terms of I want to make sure I'm clear on the question. So in terms of capital commitments, the committed capital to date, we're at 20 million on that 50 million kind of first close target. There is
well, I guess what I mean, Darren, is if somebody wants to invest $5 million, do they invest the entire 5 million, or do they invest as you find deals and you issue capital calls to qualify?
Definitely it's capital calls. So the commitment, if you will, is made to the fund, and then as we identify investments, we conduct the capital call.
Okay, so they're not being charged on any only committed capital. Well, not committed, yes, but actually that's placed.
So the management fees that the fund charges are based on the committed capital.
Committed capital. Okay. Is there anything else you would like to add, Darren? I mean, this was a very, very informative and phenomenal presentation.
Thank you, Andrew. I think I mean, there really is so much here, but I guess from the standpoint of the moment in time that we're in, and so we have all, of course, seen and witnessed, much of the unrest and such that has transpired, and while it doesn't always get talked about, often the underlying piece is often the lack of economic opportunity. And so hence the work that we've been at for again, 18 years now to address that. And so there's a lot to unpack with respect to the reality that, of course, not to get into the dark elements, if you will, of our past, but being founded on separate but equal, which was constitutional law in this country, literally spawned dual ecosystems. And frankly, other than our fairly recent civil rights work, solving for these, disparities and the like, when you start talking about things like equity capital, that has really never been intentionally integrated. We began with, our school systems and education, et cetera. And so just given those realities, there's so much work to do to address. Of course, there's phenomenal exceptions and great success stories out there, but in terms of the masses, there's still so much work to be done to better integrate our economy, particularly from an equity capital standpoint. And we stand at the forefront of that in so many ways: partnerships with national philanthropy, partnerships with major corporations, partnership with the federal government. Would love to expand that to family offices to not only address these issues, but do so in a way. This is not from the standpoint of our fund. This is a return-seeking fund, meaning that we know that there are great business opportunities to be had, but an underlying social impact. As these companies grow and scale, they'll create jobs for many of the underserved populations and communities, and the economic ripple effect of growing more sizable, diverse firms really allows for the kind of economy that I think all of us want: more consumer spending, more investment across a multitude of companies. I often say that, kind of wrap up here, this work is not a zero-sum game, meaning that as we grow more sizable minority firms, they create jobs for not just people of color, but for everyone. They create investment opportunities, not just for people of color. We have some amazing investors across the diversity spectrum in some of our earlier companies. And so it is a win-win for all involved, but it does require the breaking down of institutional just barriers and historical obstacles that in many cases still exist today. We are fortunate to be in a position to facilitate those engagements, facilitate those networks, but beyond the facilitation, make sure that the entrepreneurs that we're working with are really prepared to do business. And so we couldn't be more excited for all that's happening. There's lots of follow-up material that I'm delighted to share, but just having this moment with everyone is a blessing to me. So I really appreciate the opportunity, Andrew.
Absolutely. And this is for anyone that either signed up late or we have a copy of this presentation that we can send a link to. Again, anyone that wants to watch this at a later date or send to a friend or someone you think may be interested. Darren, I want to thank you very much. A really superb job and very enlightening and informative, and in my opinion, probably one of the most effective ways of actually getting results. And I really want to commend you on that.
Thank you so much, Andrew. I appreciate that. It's been a journey.
Well, so have a great day, everyone. And again, thank you, Darren.
Thank you so much. Thanks to all.